Over the past few months, I've deeply immersed in relentlessly studying order blocks. I've poured countless hours into analyzing and trading over 100 order blocks using a live $10,000 account across every trading instrument I could find. I meticulously documented everything, every price movement, every candlestick formation, every prevailing market condition, and naturally every outcome, whether a win or a loss. And what I discovered, it was truly a revelation. Listen carefully. You can absolutely build an entire profitable trading career solely by mastering order blocks. And here is the crucial point. It's not about trading every order block you encounter. It's about mastering the specific identifiable conditions that differentiate the highly successful order blocks from those that will deplete your account. And today, I will be revealing all of these discoveries to you. Forget relying on guesswork. Forget about lagging indicators. Forget spending endless hours on confusing analysis. This isn't about adding more complexity. It's about simplifying and concentrating on what truly matters. This isn't just another strategy, it's a complete blueprint. A blueprint that, if followed diligently, will equip you to identify, analyze, and profit from the highest probability order blocks the market presents. And I'm talking about pinpoint accuracy applicable to any trading instrument you select. Before we dive into the nitty-gritty of identifying and trading high probability order blocks, we need to get crystal clear on what an order block truly is, and just as importantly, what it isn't. There's a lot of misinformation floating around, and it's crucial to dispel these myths right from the start. There has been significant misrepresentation and understanding regarding order blocks. Many believe an order block is simply the last bullish or bearish candle before a strong move in the respective direction. Specifically, they say it's the last bearish candle before a major bullish surge, or the last bullish candle before a significant bearish drop. However, this explanation lacks logical depth. An order block is not just the last candle, it's a zone on the price chart where exceptionally high trading volume occurred, marked by a break of the support or resistance levels. To grasp order block formation, understanding support and resistance levels is crucial. A resistance level is formed when a buy candle is immediately followed by a sell candle, with the buy candle closing and the sell candle opening at that level. Conversely, a support level arises when a sell candle is followed by a buy candle, where the sell candle closes and the buy candle opens at that level. Another block materializes when a breakout occurs from either a resistance or support level. The entire breakout region extending from the resistance or support level down to the candle that initiated the move, specifically to the wick of a candle that provided the liquidity for that impulsive move, defines the order block. It's not just a single candle, it's the entire zone from the breakout point at the resistance or support level to the wick of the candle that fueled the impulsive move. I hope you now understand the distinction. The previous simpler description incorrectly identifies an order block as merely the last candle. Crucially, if a clear support or resistance level defined by opposing buy and sell candles isn't evident, then an order block hasn't formed. Okay, let's examine some real-world examples on charts to identify order blocks. We start by USD-JPY pair on the daily time frame. If you look closely, you observe that the price is in a downtrend followed by a pullback. Upon the return from this pullback, anticipating a continuation of the impulsive move, you will notice a support level here. There is a clear break of this support level by this candle, confirmed by a close below the support level. This is where an order block is formed. The order block is this entire area encompassing the support level from its beginning down to the candle that generated the impulsive move. This is your order block zone. We will observe how price reacts upon retesting this zone. As you can see, upon the retest, price came up to this zone, was rejected and moved back down. For a second example, you will notice that the price is in a clear downtrend with subsequent pullback. On the retest of this pullback, anticipating a potential continuation of the downtrend, you will observe an order block right here formed by this clear break and close below the support level. We are going to map this area as the order block. We will then watch how price reacts upon retesting this area. As you can see, when price retested the order block area, it was rejected and started moving downwards. There was even a second retest of the order block area, which also resulted in rejection, and price continued to move down again. The reasons why this happens are beyond the scope of this video, but we will cover that in a later video. For now, understand that this is how order blocks are marked, and this is the correct and logical way to identify order block area. If you review your charts, you will find numerous examples of this. This is the right and logical approach to marking order block area. Remember, the key characteristic of order block that attracts traders, and the purpose of this video, is that when price revisits these areas, it subsequently reverses its initial direction. This reversal, as you are aware, offers a tradable opportunity. Alright, now that we have cleared away the misconceptions, let's get down to brass tacks. After analyzing 100 order blocks, I've distilled the essence of high probability setup down to 2 categories. These are the pillars upon which we will build our strategy, the non-negotiable elements that separate the wheat from the chaff. If another block doesn't tick all 2 of these boxes, I simply ignore it, no exceptions. 1. The specific characteristics of the order block formation itself. Let's discuss the essential characteristics that every order block I traded had to possess before I considered placing a trade. The first characteristic is inefficiency. The order block must be associated with a strong, impulsive move that creates a noticeable price imbalance. This indicates strong buying or selling pressure. Why is inefficiency crucial for a high probability order block? Because inefficiency is what draws price back to the order block. The market hates imbalances. It constantly seeks to fill these gaps to rebalance itself. When we see a significant move from an order block that creates inefficiency, it's a strong signal that price is likely to return to that zone to correct the imbalance. This return to inefficiency is where we look to capitalize. Fair value gaps are the most obvious form of inefficiency. A fair value gap occurs when price jumps from one level to another without trading in between. Gaps are clear virtual representation of unfulfilled orders and market imbalances. Here on the chart, you can clearly observe a breakout of a resistance level, which indicates the formation of an order block. This entire area constitutes the order block. If you examine closely, you will notice that this order block created a fair value gap. Based on the criteria we've just discussed, this fair value gap enhances the probability of this order block being significant. Therefore, we anticipate that when the price returns to this order block area, we will see a clear rejection and a continuation of the upward trend. In essence, inefficiency tells us that the move away from the order block was powerful and unbalanced, increasing the probability of a return to that zone. The second element an order block must possess is untested. This is absolutely crucial. The order block must be untested. This means that price has not yet returned to mitigate or interact with the order block since its formation. Think of it like a coiled spring. The first time it's released, the energy is at its maximum. Subsequent releases are weaker. Untested order blocks are fresh, potent, and have the highest probability of reacting strongly. Once an order block has been tested, its potency diminishes significantly. Each time the price visits an order block, it diminishes the quantity of unfulfilled orders remaining within that zone. Eventually, after multiple tests, the order block becomes depleted and loses its ability to generate a strong reaction. Here on the British Pound daily chart, you can observe a clear break of the support level and the formation of an order block. We will now wait for a retest of this order block to see how the price reacts. If you watch, we see a test and rejection from this order block, which marks its first test. At this point, this order block is considered tested. Therefore, when the price returns to it again, we do not anticipate a significant reaction. As we can observe here, price returned to it and there was no further reaction. An untested order block is like a fresh supply or demand zone, untouched by previous price action, and therefore more likely to generate a strong or decisive reaction on its first test. For another block to be considered high probability in my trading, it must exhibit all 2 of these characteristics: inefficiency and untested. If even one of these is missing, the setup is simply not worth the risk. Before we proceed to explore my findings on the conditions for an effective and profitable order block setup, let me share exactly how I conducted this research, because the methodology here is crucial. I developed a simple trading framework that would eliminate any emotional bias and give us concrete actionable data that you can replicate. The framework is simple. Number 1, identify a high probability order block that has the characteristics and meet the conditions we will discuss in a moment. Number 2, place a limit order at the beginning of the order block zone and put your stop loss at the end. Number 3, we target 2 times our stop loss range for profit. This way, even with a 35% win rate, we will still be at break even. Number 4, I train my stop loss to increase my risk to reward ratio as the trade commences in my direction. To illustrate this concept, let's examine the Euro USD chart. As you can see, a clear support level has been breached, creating an inefficiency. This indicates that a high probability order block is situated right here. What I would do is to place a limit order, anticipating that when the price retraces to this order block, it will trigger my entry into the market. I will set up the order at the price level of the former support, positioning my stop loss just above the next price level above this support. As we observed in this example, when the price approached the order block, it reacted and reversed, ultimately hitting my take profit, which is set at a 2-to-1 risk to reward ratio. Once I identify an order block that has the necessary characteristics and meets the specific conditions, which I will detail shortly, I place a limit order. Without hesitation, emotional influence, or additional confirmation, I execute the trade on the same time frame. Below is a detailed overview of my testing environment provided for those who wish to replicate this exercise. For this exercise, I concentrated on highly volatile currency pairs. Over a 1-month period, I analyzed and traded more than 7 of them. The reason I could efficiently transition between pairs, analyze them, and place up to 100 trades without becoming overwhelmed was that I focused solely on identifying and trading only the valid order blocks on the 1-hour time frame. I chose the 1-hour time frame because it provided the perfect balance between noise and significant price moves. If you go too low of a time frame, you're battling market noise. Too high, and you risk missing crucial market structure details. I started with a live account of $10,000. For each trade, I risked exactly 2% of my account because that's enough to generate meaningful returns when we are right, but not so much that a losing streak will devastate my account. This is crucial because, as you will see later, even the best order blocks don't work 100% of the time. Out of the 100 order blocks we analyzed and placed a limit order for, 28 of them never even triggered. Yet we ended up in profit. Think about that for a moment. Almost a third of what looked like a valid setup never came into play. This is a crucial lesson about patience in trading. Many traders frustrate or modify their entries out of impatience, but our data shows that waiting for the perfect setup is absolutely beneficial. Of the remaining 70 other blocks that did trigger, 21 resulted in losses, while 51 hit our profit targets. At first glance, a 51% win rate might not sound impressive, but here is the game-changing detail. Because we structured our trade with a minimum 1:2 risk to reward ratio, that 51% win rate actually resulted in a 127% account growth. This completely changes the common belief that you need a high win rate to be profitable. Recall our earlier discussion on the key characteristics of a valid order block. However, not all order blocks possessing these characteristics perform equally. Many fail to hold price, as my test results demonstrated. Through extensive testing, I have identified specific patterns and conditions that significantly enhance the probability of a valid order block succeeding. In our context, an order block succeeds if, upon price returning to it, price stalls and reverses, creating a tradable opportunity. Before we proceed to look into the details of this condition, to commemorate my 10th anniversary in trading, I'm personally going to mentor a select group of traders to achieve elite performance. I'll guide you step by step, building your skills until you reach the top 1% of profitable traders. I call them the 1% Club. If you're interested, click on the link in the description to join the 1% Club on Telegram, where I will provide details of the mentorship. Let's proceed to look at the specific conditions. When we talk about trading with order block, there are 4 main conditions to think about. Imagine these as filters to help you find the best trade. Let's start right at the beginning with the first one, which is market structure. Market structure, in simple terms, is just how the market is moving and forming patterns on the chart. Let me show you some common patterns that you will see happening practically every day. Take a look at this first example. The initial market structure condition presents itself in this scenario. We have resistance levels here, here, and here. Observe that these resistance levels have been broken. Consequently, other blocks have formed in these 3 regions, here, here, and here. Our focus is to determine where the market will react from and subsequently push upwards. We need to assess whether the first, second, or third order block will hold price. However, note the gap between the second and third order blocks. This gap, known as fair value gap, indicates an area where price moved rapidly, leaving behind unfulfilled orders. Due to this gap and the presence of the last order block, the first 2 order blocks are less likely to hold the price. Therefore, we won't consider them high probability order blocks. We anticipate a situation where the price breaks through them, fulfilling orders and rebalancing the FEG before reacting from the last order block. As you can see, that is precisely what occurred. The price swept through, rebalanced the FEG, and reacted after mitigating this final order block. This is crucial. You always need to look to the left of your chart to see what happened before. If you do that here, you will spot the gap between the candles right below our first order block. A gap, as you know, is an area on the chart where price jumps from one level to another without trading in between. Now, when you see this kind of setup, there is a good chance that the price is going to come down to fill that gap and grab the liquidity below the first order block and may only react and reverse from the second order block below. Liquidity in this context refers to areas where there are a lot of orders, like stop loss orders or pending orders. Think of it as fuel for market movement. So when you see this specific pattern, a gap and another valid order block right under the first one, we actually do not consider the first order block as high probability for a limit order. And we only trade from the first order block with a market order after we have received clear additional reversal confirmation signal when price reaches it. In this scenario, there is a high probability that the first order block is acting as a form of liquidity trap. Now let's look at the opposite scenario, the second pattern. Here again, you have a valid order block. And if you look to the left, you can see that this price move has swept the liquidity under these equal lows. Equal lows are just areas where the price has formed lows at roughly the same level. These areas are magnets for stop losses. A liquidity sweep is when the price moves down to grab these stop losses. This sweep can actually fuel future upward movements. So when you see this pattern and order block that forms after a liquidity grab under or above equal lows or higher, I immediately place a limit order for the trade. Okay, let's make this clearer with some real chart example. Observe this scenario. There is a liquidity injection area here characterized by equal lows. Bullish traders place their stop losses here expecting the price to rise. However, to the left there is another order block zone that the price is likely to revisit before pushing upwards. When a liquidity injection area, equal lows in this case, exists just before an order block, it exponentially increases the potency and probability of that order block hold. This constitutes an A1 plus order block trade. Watch what happened. The price clears the liquidity area, mitigate the order blocks, and then creates another order block as it moves upwards in a bullish direction. A second key observation from this setup is the order block created after the liquidity sweep. Another block created after a liquidity zone is a high probability order block. Other blocks associated with liquidity zones are generally considered high probability. Every single time you have a losing trade, it doesn't automatically mean you made a mistake in your analysis. Remember, no trading strategy works every single time. We can't control the market. Losing trades are part of the game, even with the best setups. Okay, let's move on to the second factor, market volatility. Volatility is how much the price moves around, how much it fluctuates. When we looked at the result of our trading, we noticed that most of our winning trades happen on days and sections with high volatility. Usually, the first and the last days of the trading week can have lower liquidity. Liquidity, again, is how easily assets can be bought and sold. That's why you will often find that the majority of winning trades happen in the midweek, Tuesday, Wednesday, Thursday. Also, for pairs like euro dollar, it's best to trade during the most volatile times of the day, like the London and New York sections. If you try to trade outside of these times, you might not see the kind of movement you are looking for. It just might not make sense to trade other blocks when the market is very quiet. The third factor is market trend and freshness. We have already talked about trends a bit. Other blocks have a much higher chance of success in trending markets compared to ranging markets. A trending market is moving clearly in one direction, either up or down. A ranging market is moving sideways without a clear direction. So it's always better to trade other blocks that are in the direction of the dominant market trend. Go with the flow. Also, trading recently printed order blocks is generally more effective. Fresh order blocks, as we call them. The market is constantly changing direction. If we spend too much time waiting for the price to come back to a very old order block, it can often lead to a losing trade. Why? Because demand and supply are constantly shifting, fighting for control. Trading fresh order blocks tends to have higher win rate because they reflect the most recent market conditions. When we have a clear trending market, see how often the market prints fresh order blocks, reacts to them, and continues pushing in the trend direction. It's like the market is respecting these new order blocks as it moves along. On the other hand, look at this other example. Here you have a valid order block zone, but before the price even gets to this area, the market has created a lot of demand zones and then broken them to the downside. Demand zones are areas where buyers are likely to step in. Some traders might see these broken demand zones as liquidity and think that the order block will hold and they can buy there. But the point is, in this case, supply has taken control. Supply zones are areas where sellers are likely to step in. Trading this order block without confirmation in this situation probably wouldn't be effective. And that leads us perfectly to our fourth and final factor, confirmations in lower time frame. Confirmation are like extra checks you do before entering a trade. They can save you from a lot of unnecessary losses when the market decides to ignore those order blocks. Also, having a solid reason to enter a trade, a confirmation makes you trade with more confidence. Remarkably, I achieved 51% win rate without using any lower time frame confirmation in my trading experiment. Had I incorporated lower time frame confirmation, I'm confident my win rate would have been at least 75%. The order block trading strategy isn't limited to any specific time frame, But after you identify order blocks on a higher time frame, like a 4-hour, 1 hour, or 15 minutes chart, you should also zoom into lower time frames, typically 2 time frames lower, to look for confirmations and precise entry point. If you're using a 4-hour, 1 hour, or 15 minutes chart for your main analysis, you would look for entry confirmation on 15 minutes, 5 minutes, and 1 minute chart, respectively. You can use different price action setups as confirmation. Lower time frame confirmation is a vast topic that needs its own dedicated video. In the coming videos, we will explore lower time frame confirmation and other important trading concepts in detail. My goal is to make this channel the clearest and best educational resource for traders. Please like and subscribe to stay updated when new videos are released. Join the 1% Club by clicking on the link in the description below. Thanks for watching, and I will see you next time.